This short tutorial will demonstrate the use of the monthly mortgage payment calculator in order to determine how much your monthly mortgage payment will be. Now, in order to calculate the monthly mortgage payment, we need several pieces of information. We need to know the amount borrowed, we need to know the loan term, and we need to know the annual interest rate on the loan. So for demonstration purposes, let us assume that the property is being purchased for $300,000, and we're going to be making a down payment of, say, 20%, which is $60,000. That would leave a balance of $240,000. And let's assume the loan term is for 30 years, which seems to be the most common loan term. As far as annual interest, we're going to take an arbitrary rate of interest of 6%. Now, we are also going to add in the annual taxes and the annual homeowner's insurance on the property, because most mortgages require that the homeowner make a payment every month toward those expenses. So to make these numbers work for us, let's just assume the annual real estate taxes are $2,400, and that's dollars, not a percentage. And then we will assume that the annual homeowner's insurance policy is $1,200. Now, once we've inputted all that information, we will then click the calculate button, and that will tell us that our total monthly mortgage payment is $1,738.02. And that payment is made up of principal and interest on the mortgage, and the total payment of principal and interest will not change throughout the term of the loan. And in addition to that, there is a portion of the payment which is real estate taxes and a portion of the payment which is homeowner's insurance. Now, to see exactly how this breakdown works, we would click on this button that says show more information. And what that would now give us is an actual breakdown of the total payment. So for the first month, the payment portion that would be applied toward interest is $1,200. $238.92 would be applied toward principal, reducing the principal. $200 a month would go toward the taxes, which is our $2,400 here divided by 12. And then $100 a month, which is our homeowner's insurance of $1,200 divided by 12 months, would go toward insurance. Now, the principal and interest portion of this payment, the total portion of the payment, remains fixed throughout the 30-year term of the loan, because this is a fixed rate mortgage. So the first month, $1,200 would be applied toward interest, and $238.92 would be applied toward the principal of the loan. And now our principal balance at the end of the first month is our original balance of $240 less $238.92, leaving a balance on the loan of $239,761.08. Now, every month when the payment is made, the interest portion of the payment, as you can see here, drops down a little bit every month, and the principal portion of the payment goes up a little bit every month. And the reason for that is because the amount of the payment is a fixed amount. It's a total of $1,438.92. That remains fixed. So because the principal balance drops every month, less and less of that payment would be applied toward interest, and more of the payment would be applied toward principal, thus reducing the amount owed. Now, at the end of the first year, we can see that after 12 payments, our new principal balance is $237,052.77. In other words, we have dropped our principal by almost $3,000 at the end of the first year. And that is the total of these monthly payments that were applied toward principal, taken off of the original balance of $240,000. Now, if you want to know at any point in time how much you owe on the home, all you'd have to do is click to that point in time. Let's assume you'd like to know what you owe at the end of 5 years. Well, at the end of 5 years, year 5 of 30, your ending principal balance due would be $233,000 $223,330.47. So if you were looking to pay off your mortgage at that point in time, that's what your remaining principal balance would be to pay it off. And you can see that the calculator will go out for the entire term of the loan. You have the ability to click this forward for 30 years. And you can see at the end of the 30th year, which is the 360th payment, the portion of the payment then that would be applied toward interest is $7.16. The remaining $14.31 would be applied to principal, and at the end of that point in time, you would now owe zero on your mortgage. You would have your mortgage completely paid off.